So I think the sentiment in the mining industry at the moment, unfortunately, is still relatively negative. Some companies are still doing okay, they're being able to develop their projects. Some are still producing, but obviously at much lower commodity prices. But a number of the exploring companies are really struggling to keep the exploration spend going. The key issue that they're all facing is financing and having enough cash to move their projects forward. I think some of the activities that we're seeing with the mining companies, that they're really having to think of what do they do differently. Keeping the lights on has been a plan over the last couple of years, and with the prolongation of the downturn in the sector, they've really realized that they can't have business as usual of just having a small G&A spend. So we've seen a number of companies come together, try and do something different. We've got the OBAN deal, where 4 companies have come together to really try and move the properties forward, but also bring some cash from a couple of those entities into the new OBAN. There's a company such as Roxgold, which has been able to go out and get some private placement financing, as well as some project-specific financing. So again, where you've got an asset that investors are willing to back, companies are still able to progress and move those projects forward. 2015, we've seen the market cap of the top 100 go down yet again. The junior space is really suffering. I think that when looking at the space, still it's 50% dominated by the gold sector, and given where the gold price is, as well as many of the other commodities, and the lack of motivation of people buying gold at the moment, it really is suffering from a sector as a whole. When looking at previous downturns in the junior cycle, the gold price went down in 2008 for a short period, but didn't suffer the longer decreases in the global commodity crisis previously. But over the last 3 years, from 2013 through to now, the gold price has really suffered. So looking at the junior space with half of the companies in that sector, it really means that those companies have struggled. So I think there's a number of messages that we've heard through interviewing a number of the key individuals in the junior space at the moment. One of them is really to understand your business. If you understand the cash flows that you're incurring as part of that business, it's much easier then to plan on how you're going to survive and thrive going forward. Whether that's modeling cash flows out monthly or even weekly in some cases, you really have to understand the business that you've got. Other things that companies have to think about doing is if they've got debt, they've really got to be actively engaging with the debt holders, so there's an element of transparency of what the company is doing and how it's going to be moving forward. Companies may get into trouble if there's a lack of discussion and upfront planning with those debt holders of how the debt will be serviced. The other area that the companies we've seen them do is look at buying cash. There's a number of companies out there who are trading below their cash value from a market cap perspective. And so if other companies are in a cash shortage, we have seen companies come together to bring the cash from one junior with the projects from another company to help them move them forward.